Yeah, good morning, everybody. And today is Sunday, the 30th of October, 2022. And today will probably be the first day of the revision session for those who are writing financial reporting and probably corporate reporting as alike, and for the November 2022 diet examinations. Okay, today we'll be looking at some aspect of what we agreed to discuss, starting from the business combination aspect. And we will be able to look at it from the angle of what we guys have come across with respect to questions and some challenges that we may have. On that premise, I will more or less require us to more or less raise concerns or theoretical questions that we will need further clarification on before I look at examinable question with the aid of past question for us to attempt solving. And thereafter, the afternoon section of this will also look at some other areas with respect to financial instruments, with respect to earnings per share, and probably financial statement analysis. Okay, in that light, if we have any contribution or any question theoretically or general question with respect to the principle, we can ask now, depending when I'm going to more or less use the immediate past question of May 2022 financial reporting Ican examination as the first revision questions that we're going to more or less take into consideration. Okay, anyone with a question, kindly signify with a show of hands. Okay, since there's none, okay, we will look at this question, which speaks to various topics, but the first half of our discussion, we will be looking at the question on group accounts. And okay, I think that is question 3. Okay, question 3. If you have it at your side, you can also open it. Otherwise, you pay attention to this. Now, I want someone to volunteer to help read this question as others pay attention. If you're a volunteer, kindly raise up your hand and let me give you access to mute or to unmute. Okay, Abosede, you have access to unmute now.
Okay, good morning, sir.
Good morning.
Okay, so I read the question. Question 3. Daddy PLC is a first-tier entity quoted on the Nigeria Stock Exchange, NSE. The entity acquired 640 billion equity shares in Mommy PLC on January 1st, 2020. The purchase consideration comprised the following. 1, issue of 1 ordinary share of Daddy PLC in exchange for every 2 shares in Mommy PLC. 2, issue of 100 Naira 12% loan notes in Daddy PLC in exchange for every 400 shares in Mommy PLC. And 3, a cash payment of 15 kobo per share for every share acquired in Mommy PLC on January 1st, 2020. At the date of acquisition, the market price of Daddy PLC's shares was 75 kobo each. The cost incurred by banks when a fixed rate loan is paid out early is assumed to be nil. Also, Daddy PLC has recorded the 12% loan notes in the purchase consideration in the account. The statements of net position of the 2 companies as at 31st as at December 31st, 2020 are presented below. Now, additional informations. 1. As at the date of acquisition, the carrying amount of the net assets of Mommy PLC was equal to their fair value, except for an item of property which had a fair value of 50 billion naira in excess of its carrying amount, with additional depreciation of 5 billion naira in the post-acquisition period to March 31st, 2020. This has not been reflected in Mommy's PLC's statement of financial position. 2. The intangible asset was a television program designed to promote the business activities of Mommy PLC. However, as a result of new government legislation on security matters, on banditry and criminalities, such television programs have now been pronounced illegal in the country. The appropriate government security agency advised the company to immediately stop the television program, and 12 billion naira compensation is to be received from the Television Authority. As a result of the new legislation, the governing board of Daddy PLC was of the opinion that goodwill on consolidation has been severely impaired by 30 billion naira. It is the group's policy to value non-controlling interests at full fair value. The fair value of non-controlling interest as at the date of acquisition was 100 billion naira. 4. Mommy PLC sold goods worth 20 billion naira to Daddy PLC during the post-acquisition period. 5 billion naira of these goods were included in the inventory of Daddy PLC as at December 31st, 2020. Mommy PLC made a profit of 8 billion naira on the sales. And lastly, Mommy PLC trade payables of 9 billion naira did not agree with Daddy's PLC trade receivables as a result of cash in transit of 5 billion naira. You are required to prepare the consolidated statement of financial position as at 31st December 2020, total 20 marks.
Okay, you can read the information in the balance sheet, kindly unmute, except for the figures there. Please kindly read the information so that people can be aware. Thank you.
Okay, so in the balance sheet, we have the assets, non-current assets, property, plants, and equipment for Daddy PLC, 650. Okay, without the
numbers.
Okay, assets, non-current assets, property, plants, and equipment, investment, intangible assets. Current assets are inventories, trade receivables, and bank. Equity and liabilities, we have ordinary shares at 25 kobo each. Retained earnings as at 1st of January 2020, we have that. We also have retained earnings as at 31st December 2020. For the non-current liabilities, we have 12% loan notes. For the current liabilities, we have trade payables, other accrued expenses, current taxation, and bank.
Okay, thank you very much. Thank you very much. Now, I think we'll start by trying to delineate this information one after the other. Okay, let's look at this information here, and let's try and interpret it one by one. Now, the first information here says that Daddy is a first-tier entity quoted on the Nigerian Stock Exchange. The entity acquires 640 billion shares in Mommy PLC on 1st of January 2020, which means the first thing is this: we need to more or less appraise this acquisition with respect to 640 billion shares and see that what does this acquisition connote? What is the total number of ordinary shares in issue by Mommy PLC? And we'll compare this acquisition to know the proportion it is. Now, let's go into the account of Mommy PLC. Mommy PLC and Daddy PLC has their ordinary shares with a nominal value of 25 kobo each. Okay, the question then is, how many ordinary shares as 25 kobo each translated to 200 billion naira ordinary share capital of Mommy PLC? And that will be the first thing we need to do at that point in time. Okay, now, if you guys pick your calculator, can you tell me, whether by responding in the chat or a show of hands, what is the number of shares of Mommy at 25 kobo each that translated to 200 billion naira capital? Okay, Toby, you can unmute.
800 billion shares.
800 billion shares, okay?
Yes, sir.
How do we arrive at that?
The value of Mommy's PLC share divided by the nominal value of 25.
Give us 800, yeah. Okay, in that case, what then is a fraction of 640? You buying over 640 out of 800. What percentage does that represent? What percentage does that represent?
80%.
80%. Okay, let's look at it in this manner. For those that are seeing it, let's look at it here. Daddy PLC acquired, let me enlighten this. How many shares? Daddy PLC acquired 640 billion shares, okay? Now, Mommy's PLC. Is it Mommy PLC? Okay, Mommy is also a PLC. Ordinary share capital. Is said to be 200 billion naira. Okay. $200 billion. Now, nominal value of Mommy's ordinary shares is said to be 25 kobo. Okay, now the first issue that we try to solve is what is the number of ordinary shares of Mommy in issue. And what is that? It is the share capital divided by the nominal value. And that gives us 800. That gives us 800 billion naira. Okay. Now the question then is, what is the stake in percentages of that deal? And to determine that stake is simply for us to say, what is the proportion of what you acquire over the total? Okay, I'm putting this in naira. It's not in naira, sorry. Okay, what is the proportion of 640 to 800? And we're able to see that in percentages, which is 80%. And this is how we arrive at that for our information's sake. Now that is the first step. Let's go back to our question. Now, the second thing there was that the purchase consideration comprises of the following. 1, issue of ordinary shares of Daddy in exchange for every 2 shares in Mommy. 2, issue of 100 naira loan notes at interest rate of 12% in Daddy in exchange for every 400 shares in Mommy. And 3, a cash payment of 15 kobo for every shares in Mommy on this date. Okay, which means these are the 3 payments involved. Now, let's go in and construct our table for that. Purchase consideration. All figure in billions of naira. Okay. Now, there are 3 purchase consideration. One is share exchange. The other one is loan notes. And the third one is cash consideration. Therefore, we'll have to compute them one by one. Now, let me cut and paste the question there so that we won't need to switch. Someone said it's not seeing the solution. Probably you need to check your side. Okay, I believe everyone can see the solution. You can type yes. Yeah, okay. Thank you, guys. Now, let's pick it one by one. Let's pick the first one. The first one is shares consideration. Now the question then is, for every 2 shares acquired in Mommy, Daddy is going to offer those shareholders one of his own share, which means share exchange ratio is 1 to 2. And what is 1? 1, that is share, to 2, mommy's share. Okay. Now the question then is, what is the number of mommy's shares acquired? If you remember, it was 640 billions. Now the question then is, what then is the number of daddy's shares to be offered to mommy's acquired or mommy's former shareholders? Okay. Now, if you look at it clearly, for every 2 I acquired in mommy, I issue 1 additional share as a consideration for those shareholders, which then means that in that case, the number of shares will be equal to what? Will be equal to 1 of 2 times acquired shares, which means you are more or less giving half of your own shares to get 1 of mommy's shares. What it simply means is that if I acquire 2 from mommy, I give mommy 1 of mine. And how many 2 will I acquire to give 1 each? It will have been 320 billion times. And that's what it means. Similarly, imagine the question says, exchange is 2 of daddy's shares for 5 of mommy's shares. It will have been ratio 2 to 5. That means 2 over 5. And that will have given us this. Okay. Take note. Any question on that? Any question on that? Okay. If there's no question, therefore the question then is, what is the fair value of daddy's shares offered as consideration? And the fair value equal to the market price of money, daddy's shares at that acquisition date times the number of shares offered. And how do we do that? If you remember, daddy's share offered is 320 billion shares. And let's go back. What is the market price in the question? What is the market price of daddy's shares? Who can tell me? Somebody says 75 kobo. Okay. Where do you obtain the 75 kobo? You can raise up your hand so that you can explain, and one or two other of your colleagues will, okay? Let me grant you access. Okay, you can mute.
Okay, so from the question.
Yes.
After they told us the purchase consideration compositions, so they said at the date of acquisition, the market price of Daddy PLC's shares was 75 kobo. So I assume that's the market value we need.
Yes. Okay. Can you see, as at the date of acquisition, the market value of Daddy share was 75 kobo. Okay, that's where it came from. Okay, we'll come back here and say 75 kobo multiplied by 320 billion shares. And therefore, what do I do here? 0.75 times this 320. And I get my Naira value. Okay, that is that. Which means I'll come here and say this is 240 in billions. Any question on this before we move to the second consideration, which is the loan notes? Loan notes is otherwise known, as I've always taught you in class, as debt consideration. When it comes to business combination. Okay, no question. Now let's go back to it here. In addition to the share consideration, Daddy will also issue a loan note, which means that it's going to acknowledge that it's owing additional amount to the shareholders of Mommy that surrender their shares. And it's issuing a loan note at the rate of 100 Naira per note. And that loan note will attract interest of 12%. And one loan note is equivalent to 400 shares of Mommy acquired. What does that mean? We'll go back and ask ourselves, how many loan notes should Daddy issue to the former shareholders of Mommy? Now, this question is as a result of agreed exchange ratio is one loan note, which is at 100 Naira per note, is equivalent to 400 shares, 400 acquired shares. In Mommy. Therefore, if we take note of this, similarly, that ratio, we ask ourselves this question. Now, we'll now refer back that the total shares acquired in Mommy is still this, which I can link to 640. Now, we'll now ask ourselves that based on the ratio, the number of loan notes now to be issued will equal 640 billion divided by 400 shares. That is 640 billion shares. And what does that give you? It means 640 billion shares divided by 400 will give you how many loan notes? Remember, this is in billion. Let me multiply it by 1 billion divided by 400. That gives me 1.6 billion. That gives me 1.6 billion. Okay, shares. Sorry, 1.6 billion loan notes. Okay. Now, each loan note is how much? What is the fair value? Similar to what we did here. The fair value will now be the nominal value of loan notes multiplied by the number of loan notes issued. And what is that? That is the 100 naira multiplied by 1.6 billion. And that will give us this amount. Now, we can now come here and say the value of the loan notes is 1.6 billion. Now, let me divide it by 1 billion to bring it back to everything in billions of naira. Okay, be careful about your conversion from billion to naira and all sorts of things. Any question about the second consideration before we move further? Okay. Okay, there's a question from Toby. You can mute.
Yeah, sir, concerning that statement that the cost incurred by bank when a fixed rate loan is paid out early is assumed to be nil.
Well, I didn't get it. I didn't get it. What do you mean?
Where you have the cost incurred by banks when a fixed rate loan is paid out early is assumed to be nil.
Yes.
Let's assume there's a cost incurred for you to get the loan note. Will that be expensed, or how do you classify that? Recognize it in the statement?
Now let me take people back to the question. This is what we were saying. Here they said, I'm trying to highlight it. Okay, don't worry. The cost incurred by banks when a fixed rate loan is paid out early is assumed to be nil. Okay, yes, what they are telling you is even when you pay your fixed rate loan early, therefore, there's assumed that all what you have agreed to do is that interest or principal are paid as at when it's due. Whether you prepay early or not will not stop you accruing interest for the period which is expected for the loan to run. For example, imagine I'm supposed to pay back my money 31st December 2022, and today is 30th of October, and I paid down. Technically, interest supposed to only accrue to October, and that is all. But in this situation, I'm still going to pay full year interest, regardless of whether I prepaid early enough or I pay as at the due date. Do you can say now? Now, your main question now is, how do you treat costs associated with issue with borrowing or issue of loan notes relating to acquisition? Is that correct?
Yes, sir.
Okay. And if you could remember, based on the requirement of IFRS 9, transaction costs relating to such a loan note that are more or less carried at amortized cost will be integral part of that amortized cost, whereby such transaction costs will not be taken as an expense, neither will it be taken as the cost of investment in a subsidiary, but rather it will be taken as a reduction of the proceeds of that borrowing, which means you use it to reduce the initial fair value upon initial recognition of such a loan note at amortized cost. Okay, and what you can also do is that you can go back to various videos I've done on financial instrument, or probably when we get to the section of financial instrument, we'll also look at it further, probably with illustrations. Is that okay?
Okay, sir. Thank you, sir.
Yeah, thank you. Any other question? Okay, in the absence of no question for now, I can't see any answer. Now let's look at the last consideration, cash consideration. Now, this will have been a deferred cash consideration, but it is not. Who can tell me why it is not a deferred cash consideration? And what is the difference between a cash consideration and a deferred cash consideration? Okay. You can mute.
I think in my own knowledge or an understanding, deferred cash consideration is amount payable in the future. Like, why cash consideration is the present, what you are paying presently.
Okay. In this question, how do you know you are paying presently or you are not deferring? Because it need not to be expressly stated. How do you know in this case that it is cash consideration and not deferred cash consideration?
The question, it said a cash payment of 15 kobo per share for every, on the date was stated on it.
Now, thank you. That's where I'm going to. Okay. If you check here, the date in which the payment was expected to be made was stated as January 1, 2020. And what is unique about January 1, 2020 is that it coincided with the date of acquisition, which means this is a payment you are making immediately. But if this case, if the date has been 1st of January 2021 or thereafter, it will have implied deferred, which means it's something that will be paid what? Later. Does that make sense now? Okay. And those are the salient things. You might find this same example in your question, but the only difference is that they changed this 2020 to 2021, whereas acquisition took place 2020. It then means it's a deferred cash consideration. Or instead of them to make it 2021, they might as well make it 31st of December 2020, which is still a year apart from 1st of January 2020. Please, guys, always take note of it. And that's why I always emphasize, principle is much more important in knowledge acquisition than just trying to cram or grab with theory. Okay, now cash consideration. Now, a cash payment of 15 kobo per share for every shares acquired in money, which means in addition to all of these two payments, you are still going to pay a consideration additional cash payments of 15 kobo per acquired share. By that in what? In money. Which then means that in that case, the fair value of the cash consideration will be 15 kobo multiplied by number of mommy's shares acquired by that. And what is that? That is 15 kobo. 15 kobo is 0.15 multiplied by how many shares was acquired? Remember, 640. And that gives us 96 million. Do we agree? If I come here, 96. What's the total now? The total consideration upon acquisition is 496. Now, I'll ask a question. Okay, somebody said, please, kindly take the cash consideration again because I didn't hear that part due to network, okay? What I said is this. How do we know that this is a cash consideration and not a deferred cash consideration? The difference is the timing of payments. If you are paying at the spot of acquisition, that cash consideration is cash consideration as the case may be. But if I'll be paying later, it means that it's a deferred cash consideration because it constitutes a liability. Now, what I'm now asking question on is that what is the difference between measuring cash consideration and deferred cash consideration at fair value at acquisition date? The difference is that if I have to pay in a year's time, it then means that this 96 million is no longer 96 today because it's a 96 million I have to pay in a year time. Which then means that today, what I'll likely have to do is to discount that 96 payable in a year time back to today. And doing that, I'll require the cost of capital, or what we call the order rate, or the discount rate. And in doing so, what I'll have done, if it is 1 year, is that I'll have used this principle that says my present value equals my future value discounted back by my cost of capital, which is equivalent of future value times the discount factor. Which then means that, let's say, it is payable in 2 years, in a year time. And cost of capital is 20%. Therefore, what I'll do is to say, this 96, I'll multiply it with the discount factor, which is at 20%. And remember, to get your discount factor is by the formula I've expressed. Which means that this is 8. If it is 2 years, for example, in a 2-year time, remember, it's due to determine the number of time based on the dates between acquisition and when the payment will be made. In this case, I'll just change this to 2, and it becomes 67, like that. And those are the things you need to take note of, which means this will have been my answer if this has been the case, or it will have been 80 if it is a year time. But since it is not, I go back to my initial position. Okay, I think that explains it clearly. Okay. Now we'll finish with that. Now there's a problem. The problem is this question. Is it accounted for? Is it accounted for? And what is it accounted for? All of this consideration have they been accounted for? Now let me do something here so that we can answer yes or no. Now, is it accounted for? Who will answer the first one? Is shares exchange already accounted for in our books? You tell me yes or no, and you tell me where we can find it in the question. Abosede said no. Are you sure it is no? Okay. Can you? Okay, let me give you access to unmute. Okay, unmute. And tell us how and why.
Okay, sir, why I said no was that when I was reading it earlier, there was, from what we were told in the second paragraph, it said that the PLC recorded 12% loan notes, while the other purchase consideration compositions were not mentioned as being recorded, and in the balance sheet to confirm the recording of the loan notes. It's just the value of the loan notes that we have under investment in subsidiary. So that was, I think, share exchange has not been recorded.
Okay, thank you very much. It's not only that you think, you know at this point, because you're able to buttress all of the facts. Now take notes. As a professional, information from your client or from your company may be directly provided, may be indirectly provided. And where it is indirectly provided, you infer from available information. Now, what am I saying? Now, if you look at this, you find out that in the question, they said something here that is key. Also, Daddy has recorded 12% loan note in the purchase consideration in the accounts, which means the only one we are given directly is information about loan notes, which has been accounted for. But that doesn't mean that others have not been accounted for. But there's no other information directly provided that talks about whether they are accounted for or not. But you as a professional, you scan through the balance sheet. And that's why I told the person that read the question to go back to the balance sheet. Don't ever omit this balance sheet or any information whatsoever it is, because that might assist you to have much more clarity. Now, if you look at this balance sheet, under investments, you can see it here. 160 was what was recorded. And this 160, are we familiar with something like 160? Let's switch. Can we see 160 in all of this? The answer is yes. You can see it here, which also corresponds to that loan note, which means indirectly now they've confirmed to us that these other two have not been accounted for. Why only this has been accounted for? The question then is, if we know that these two have not been accounted for, therefore, what do we do in that instance? I'll need an answer from someone. What do we do in that instance? You can raise up your hand or send a chat. What do we do at this instance? Purchase condition not accounted for, what do you do before you proceed on consolidation? Hello? Okay. What do you do?
Okay. We'll make accounts for it though. Well, I think the share exchange now not being recorded, that means that no, let me start from the cash consideration. I think I understand that one better. We have to add it to our bank since it has not been recorded previously. And then the share exchange, that means when we are considering, how do I put my words now? I think I understand the cash consideration better though. We'll have to make adjustments in our bank, basically, since it has not been recorded before.
Okay. Okay, what do you do to share exchange? Okay, Toby.
I think the cash exchange will be credited from the bank and you debit the cost of investment. Then for the share exchange, since the fair value is more than the nominal value, so that means you will be considering the share premium and the share capital of the parents now. So you debit your cost of investment by the total amount and you credit your share capital by the nominal value share of the 240 and the share premium by the remaining, which is 60 billion and 180.
Okay, thank you. Let's look at it now. Let's look at it. You guys have provided some clarity to it. Now let's pick it one by one. Let me pick the accounting entries. Now, you have more or less created an investment by way of issuing additional shares in exchange for acquiring that investment. Therefore, your investment in the subsidiary will increase by how much? By 240. By 240 million. This 240 billion. Now, your share capital will increase by the nominal price. Remember, what is the nominal price? The nominal price, if you come back here, is 25 kobo each for the two companies. Therefore, the nominal price of 25 kobo and what that signifies is that 25 kobo, that's 0.25 naira, times Remember, this 240 was gotten from these 320 shares. Therefore, sorry, from 640. And at this case, what do? This 640 shares was what I acquired, but I issued 320. Okay, and therefore 25 kobo of 320 shares I issued is the nominal price of 80. Now, the difference between 75 kobo and 25 kobo speaks to the premium. And in the question, we don't have share premium before, which means this is the first time we're having share premium. And share premium will be the 50 kobo balance. I'll put the word balance there. All because 25 kobo plus 50 kobo make up the market price of 75 kobo. And by so doing, it means 50 kobo, 0.5 naira times the 320. At the end of the day, the sum of 80 and 160 give me that 240 naira. Okay, that is it. Now the second accounting entry is cash consideration. Yeah, when it comes to this, I'll say no. Not required. And why? It has already been recorded or accounted for. Take note of that. Now for this, investment is also created in money. Of how much? The cash consideration of 96. Okay. Remember, this is the same 240 here. Let me just flip it to this of 96. Now, unfortunately, we should have credited cash and bank balance. But if you go back to our balance sheets, it shows something here, that our bank balance is 0, which means we collected probably overdrafts from the bank to meet up that short payment of 96. And probably that is one of the reasons why this information was made available with respect to the costs incurred by a bank with a fixed rate loan and also things like that. But what that means that in this case, what I'll simply do is to credit my bank overdraft. All because we have overdrawn from our 0 account to make that payment. And that is that. Now you can read this out. Can somebody read this out in what I've also made available to you guys? Can somebody read this out here? Technical note here. Who will volunteer? Can somebody volunteer? Okay, I'm coming. Let me enlarge it. And Oluwapo.
Yes, sir. The
Okay.
technical note is the examiner's only information concerning the components. Sorry, please, I'm trying to enlarge.
Okay, let me enlarge it here for you.
Okay, I have it now.
Is that okay?
The examiners only information concerning the company.
I think your audio is bad. Sorry, your audio is bad. And somebody else volunteer. Toby.
Okay. The examiner's only information concerning the components of the purchase price recorded in the books of Daddy PLC was that of the 12% loan notes. Though the phrase cash payment should by the examiner be confusing to candidates, as that phrase naturally depicts that since payment has been made, it should have been recorded in the books, or where it has not been recorded by way of error or omission. Such information should be directly or indirectly provided, but not in this case. A further review or investigation depicts that a piece of information contained in the quotation below may be an indirect signal that this has not been recorded because there is a possibility that the cash payment was by way of short-term borrowings. That is an equivalent of a bank overdraft. Since there seems to be no cost to it, it may have been omitted. For this suggested solution, it is presumed that the company may have committed an error of omission, which requires correction, as will be shown subsequently.
Okay.
Lastly,
and that's why I said here that recognition of unrecognized cash contribution by borrowing on acquisition of money. But again, it speaks to the same thing we've done. Thank you very much. Okay. Now let's go back. Therefore, these are since addressed all of what we need to do with respect to what has happened at the date of acquisition. Okay. Someone says, sir, I didn't understand where we got 80 billion naira from in the ordinary share capital because of network. I think you might likely have to go back to the video or recording, but let me just take this opportunity to re-explain. Now, the ordinary share capital is 25 kobo, the nominal price. If you go back to the question, remember it's 25 kobo per share, whereas the market price is 75 kobo. Therefore, you are going to recognize increase in share capital based on the nominal price. Any excess above nominal price is regarded as a premium that is recognized in the share premium account. Does that make it clear? Okay. Now, therefore, we've done all we need to do. The next thing we now need to do is to go back to our tradition of saying, what is a good structure in this case? What's a good structure? Okay, sorry. My system is trying to malfunction. Okay. Okay, the good structure Daddy and mommy. Now, remember the stake of daddy and mommy? What we did earlier, we arrive at 80%. Therefore, 80% non-controlling interest is 20%. Recall, when was the date of acquisition? The date of acquisition was 1st of January 2020. And from our balance sheet here, we are reporting when? 31st of December 2020, which is just a year after. Which means our reporting date or date of consolidation is 31st December 2020. How many years apart? 1 year. And take note of this 1 year, it has consequence. But before then, we need to split our reserve into pre and post. But there's something here that we need to take note of. Now look up here. Look at this information. Who can interpret this for me? Because this is where many students got it confusing. You have to retain earnings. Who can interpret this? Okay. To be, go ahead.
Yeah, I think the retained earnings are at January 1st. That's the retained earnings at the beginning. Why the retained earnings are at 31st of December? That's like the accumulated, that's not for the year, that's just for the accumulated to January. Then if you want to get for the years at year end, then you add the two together. Am I making sense?
Okay. Yes, you are making sense, but you are mixing up. I understand what you've said, but one of the language you use is conflicting. When you use aggregation, you are using it to confuse the situation. Okay, now let me explain. Now, this phrase should not have been used here as retained earnings. Or where it will have been used as retained earnings, probably will have said retained earnings for the year. But the way they connoted it, many students treat this as if this is retained earnings at the end of the year, and the first one is retained earnings at the beginning of the year. The answer is not correct. You can't have two retained earnings in the balance sheet. What you simply have is that this first one is the opening retained earnings, which is the cumulative retained undistributed profits as at the beginning of the year. Whereas this is profit for the year. And if it's negative, loss for the year, which runs between the beginning of the year and the end of the year, which then means that in this case, I will reconstruct it as this for you so that I can understand what I'm saying. Which means retained earnings as at 31st December 2020 is as follows. You know, we have daddy and we have mommy. Now, all figures are in billions of naira. Now, do you guys get it now? This is what is given. What that means that is either they show this in the balance sheet or they show this too in the balance sheet. It's the same thing, and that's what they've tried to do in that case. But for those that treated retained earnings as at the year end as that 150, which is in this question, will have gotten it wrong totally. This is not retained earnings as at the end of the year. It's rather the retained earnings for that year, which if you add or subtract from the retained earnings at the beginning, depending on whether it's loss or profit, you will arrive at the retained profit at the end of the year. Okay, that is that. Now, what do we intend doing? What we intended doing is that we want to determine pre and post. Pre and post acquisition results of Money PLC. Now, how do you determine that? Pre-acquisition retained earnings is as at acquisition date. And what is the date of acquisition? 1st of January 2020, this date. And it coincided with this date, which means that I can tell you that vividly, this 120 is pre-acquisition. Now let me get an arrow. Okay, that is that. Now, my post-acquisition profit or loss is a function of what is my retained earnings at the end of the year, which in this case is 170. And therefore, all things being equal, is a movement between this end and the pre-acquisition that give me my post-acquisition. Therefore, this is what I'm looking for, which is my post-acquisition in that year. And fortunately, it's coincided with this, all because acquisition took place at the exact beginning of that year, which means that the entire profit in that year is post-acquisition. That is that. Now, what else do we need to do? Let's go back to our question. We've treated all information here, which means we have no reference here. The only reference we have here, which you have to take note of, is this interest on this loan, because this loan, by the end of the year, when we want to consolidate, we must be able to accrue for the interest on the loan. The only time we may not accrue is if this interest has already been accounted for, which we don't know yet. We'll get back to that. 2, we have dealt with all of this information here. Okay, therefore, let's go into the additional information. The first additional information here is that as at the date of acquisition, the carrying amount of the net assets of Money PLC was equal to their fair value, except for item of property, which had a fair value of 50 billion naira in excess of its carrying amount. Let me stop at that point. Recall that in line with the requirements of IFRS 3, that upon acquisition, you need to fair value all of the asset and liability acquired. And if there's a fair value difference, that should be used to adjust for the pre-acquisition retained what? Earnings. Okay, or before you determine any amount of goodwill or gain arising from bargain purchase transaction. Therefore, let us see how we deal with this information. Now, this is the additional information which I've brought in here. Now, accounting for fair value gain on acquisition of Money PLC. Remember, there was fair value gain on property alone, because all others have the fair value equal their carrying amount. Therefore, accounting entry. Now, normally, I'm supposed to find the fair value of the property compared to the carrying amount of the plant. But in this case, they've done that for me. And they've told me that the fair value was in excess of the carrying amount by 50 billion. Which then means that I have to more or less show an upward trend or value of my property, which means items of property, plants, and what? Equipment will increase by 50 million naira or 50 billion naira. The corresponding credits will go to pre-acquisition reserve. Okay. Now take note. There's also information regarding additional depreciation. Because you've revalued an asset upward, it will trigger additional depreciation, which was not captured in the old value. Therefore, instead of us to be allowed to compute the additional depreciation, the examiner has already computed it for us, which means the examiner is a nice person. Therefore, additional depreciation on property, and this is subsequent to acquisition. And the effect of that is that the effect will only affect post-acquisition profit and not pre-acquisition, because this is an aftermath to acquisition. Therefore, again, for depreciation, it will reduce the value of the property, plant, and equipment, which means as an asset, to reduce the value, you have to credit it. And it's going to do what? Reduce the post-acquisition profit from 50. Okay? And to do that, we have two options. I can reduce this 50 directly by charging it to this post-acquisition profit before I share it, or I can do it in such a way that since I know I'm going to share post-acquisition profit to the parent and non-controlling interest, I would rather also share this to both. And I'm still going to show you the two solutions. Therefore, let me use the first approach I do use. Therefore, the effect of this is that it will affect the profits, which invariably affect the consolidated retained earnings. Let me just put it like that. And that is from the angle of the parents. And the second one will affect the non-controlling what? Interest, which is the angle of the NCI. And I'm going to show you at the end why the two approaches are the same. But depending on which one you are comfortable with, you'll see what to do. Now, this is 5 billion. And if you are to more or less divide the impacts that affect the post-acquisition profit between the parent and the NCI, we call parent is 80%, which is this. 80% of what? 5 million. And NCI is 20%. And to do that, I can quickly come here and say, if the stake is this, therefore, non-controlling interest will be what? Remember, it's just 1 minus the percentage of the parent, which is 20. Okay? Therefore, I'll also do the same thing here, 20% of the 5 million, and that is that. Okay? And we're going to see the effect of what I've done later. Now let's go back to the additional information again. Additional information 2. Can somebody read this and interpret what it is for me before I provide my own interpretation? Who volunteers? Who volunteer? I'm waiting. Okay, over to you.
Okay, so the question says, the intangible asset was a television program designed to promote the business activities of Mommy PLC. However, as a result of new government legislations on security matters, on banditry and criminalities, such television programs have now been pronounced illegal in the country. Thus, the appropriate government security agency advised the company to immediately stop the television program, and 12 billion naira compensation is to be received from the television authority. As a result of the new legislation, the governing board of Daddy PLC was of the opinion that goodwill on consolidation has been severely impaired by 30 billion naira. Okay, I think the most obvious one is we have a goodwill impairment of 30 billion. So if we have positive goodwill, so it will be, if it is a full goodwill, we would allocate it to the parent, but if it's partial, to be divided between NCI and parent. I hope I'm not mixing it up. Okay, for the intangible assets that we have in the balance sheet, with what was mentioned here in this additional information, I think we would have impairment of that intangible asset such that it will no longer reflect in the balance sheet since it is now illegal. So to take it out of our books, okay, to take it out of our books, we would have to subject it to impairment, and I think it's a full impairment since we are taking everything out. Then the 12 billion compensation to be received from the television authority would, I think, affect our bank. So I think that's what I understand.
Okay, who else again? Toby.
Yes, sir. Can you hear me?
Yes.
First of all, I want to refer you back to additional information 1. The additional depreciation is to March 31st and not the full year. I think you only consider the 5 billion, but the 5 billion is to March and not the whole year. That's one. Then back to information 2, additional information 2. The first thing we have to do is we recognize the 40 billion that was recognized as intangible assets. Since it's now illegal, we have to remove it from our books. Then the 12 billion that will be received will be an asset to us, like a receivable to us. Then we recognize that also.
Okay. Any other question or contribution? Amusa, do you have the C up? Are you asking questions? Okay, you can put your hands down. Any other question or contribution, please? I want you to interpret it in the way you know it, and let us discuss it. Who else? I want some of us to contribute, please. I'm still waiting.
Oh, sir, I stepped out a minute.
Okay, I saw your hand up.
Oh,
and I want to know what's the question.
No, that was the previous question. I should have lowered my hand.
Okay, who else will add question or consideration of that information so that I can be able to express my own view? Okay, Toby, over to you.
The question now concerning the information 2 is, since we know we will recognize and we will be considering the compensation. Now the question is, when will it be recognized? Is it the reporting date or the date of acquisition? That's my question. Like those transactions, when will we consider them? Is it at the reporting date, or that's the date of consideration, or at the date of acquisition? Thank you.
Okay. Which other question? Okay, now let me try and give you further explanation on them. We make mention of something first. Now let me switch. And that's why it is critical for us to look at our view. Here, they said this is to 31st of March 2020. And I'll tell you that even this is the first time you're pointing my attention to it, which even all through my reading, I never sensed this date to be different. Because when I was reading it in my own mind, I saw this 31st as 31st of December, which means for the whole year. But what has this brought to us? What it has simply brought to us is that, which is a question I will put to you. If additional depreciation is 5 million for 3 months, 3 months being between 1st of January 2020 and 31st of March 2020, what then would have been the full year additional depreciation? Now, two things you state. State the assumption you have made and why you have made such assumptions, and the full year, not fully, full year depreciation. That's additional depreciation. Who will answer that now? Okay. It seems to be Ambose are the major people in the class. Out of about 40. Okay. Some people don't want to talk. Yeah, over to you.
Okay, let me try. I think the assumption there is that no addition in the year to assets, and the policy they use is consistent. Let's say straight line depreciation. So that's the assumption for that 5 million for the 3 months.
Now let me take note of it. The only assumption that is valid for what you have said
is there is no addition in the year.
No, it's never addition, because even if there's addition, the additional depreciation we are talking about is of acquired assets at acquisition. Therefore, we are not interested in additions during the year. We are talking about assets you have fair valued, and of which the fair value is creating additional depreciation. The only assumption that is here is that it's a straight line depreciation. Now, given that that's the assumption, therefore, what is the value? What is the full year?
The full year depreciation will now be, since the 5 million is for 3 months, then we have to get that of a month and multiply it by 12 months.
Which
that means 5 million divided by 3, 10 times 12.
It's simply grossing up 12 months out of 3 months.
Yes.
Of 5 million naira.
Yes, sir.
Or simply say, if 5 million is for 3 months, 1 month will be 5/3. And whatever I give you is per month, multiply by 12. And what do you get? You
20
get
million.
20 million. Have you?
Yes, sir.
Yeah. Therefore, what that means to come here to change this. And the beauty of model is that once you come here to change it, which is 5 times 12 divided by 3, it gives us 20 and it updates everything. Does that make sense now? That is that. Now, let's now look at this information here. The intangible asset was a television program designed to promote business activities of Mommy PLC. However, as a result of new government legislation on security matters, on banditry and criminalities, such television program have now been pronounced illegal in the country. Thus, the appropriate government security agency advised the company to immediately stop the television program, and 12 billion compensation is to be received from television authorities. Now, what does that mean? The first thing it means is that the intangible assets, which is a television program, that means the right you have over that program, is now being fully impaired. That's the first assumption I can make here. And if it's fully impaired, it then requires a total write-off. That's just. How do you write it off? I debit. And I debit the group profits. And remember, the group profits, which is a part of the profit emanating from the subsidiary, from the aspect or angle of the subsidiary, we automatically has effect on the following. Consolidated retained earnings, which is the parent, 80%. And the non-controlling interest, which is the NCI, 20%. And the corresponding credits affect the intangible assets, which is the television, now that is the entire 40. It's written off 80%. Remember the 80% here. And the 20%. Okay. Now, there's a contingent, I won't call it a contingent asset, a reimbursable asset. Okay. Regarding the recognition of the intangible assets. And what is it? If you go back to the requirement of IS 37, therefore, since it is validly going to be received on the premise that we have to write off our rights because we can't no longer use our program and government must compensate us in part. They are compensating us for 12 billion, whereas what we lost is 40 billion. Therefore, what do? The accounting entry will be to recognize compensation receivable which can be part of your trade and other receivables, and a credit to group profits to reduce the impact. Let me just put it here. To reduce the impact of that loss. And that's 12 billion. Now, but this compensation receivable, okay. And remember, this impact here which is a credit to our profits coming from subsidiary will be shared between the parent and NCI. In what ratio? 80-20. Again, we'll come back 80 of 12 and 20 of 12. And that is that. Now, there's now an issue about impairment of goodwill, also resulting from that. Because the goodwill is coming from the perspective of the subsidiary. And let's go back here. We are told here that as a result of new legislation, the governing board of Daddy PLC was of the opinion that goodwill on consolidation has been severely impaired by 30. Now, how do we account for that? The first thing is that to account for it, we must know what form of goodwill it is. From this information here, even when we have not computed goodwill, who can tell me what form of goodwill is it going to be arrived at based on the accounting policy of the company here? Can somebody read this for me? I'll use it to answer the question. Somebody said full goodwill. I want somebody to explain why it is full goodwill. And how do we treat impairment loss on the full goodwill? I wait your hand. I don't want to call names. Okay. Now, it is full goodwill. Okay, somebody's raising hand. That's how to raise hand, Benga, but let me search for you. You raise hand through the device, but let me search for you. Benga. Because if you raise your hand normally, okay, you can mute now.
Sorry, I've been struggling to know how to raise my hand. That's how I start. So
Okay.
it says
No.
the group policy is to value the NCI interest at full fair value, and the fair value of the NCI interest as at the date of acquisition is 100 billion naira.
Therefore, what is it? Since we are valuing NCI at fair value, it then means that resulting goodwill there, if any, is a full goodwill. And where full goodwill has been impaired, it then means that such impairment loss will be borne ultimately by the shareholders of the subsidiary, which comprises of the parent and the non-controlling interest. Therefore, in this case, as I debit the group profits, the effect of that will affect the parent and the NCI in the ratio, the share profit or loss. Whereas the full goodwill is impaired to the tune of 30 billion. If I write 30 billion, 80% of it affect the parents, while 20% of it affect NCI. But what if the accounting policy is not to measure NCI at fair value, but rather to measure NCI at proportionate share? What will have been the treatment of this impairment loss? Who can answer that question? Okay. Let me give Kade, who's raising up for the first time. Kade, over to you.
Thank you, sir. It means it's going to be the impairment loss is going to be for only the parent company alone.
Okay, thank you very much. Thank you very much. Which means in this case, because it's full goodwill, the impairment loss is going to be borne ultimately by the parent and the NCI in the proportion of the share profit or loss, which is what we've done here. 20% to the NCI, 80% to the parent, while the full goodwill is reduced by this. Therefore, this will now require us to compute the goodwill. Goodwill computation. Now let's compute our full goodwill. All figures in billions. Now, what's our cost of business combination? Purchase consideration of Daddy PLC and the value of non-controlling interest. Now, if you remember, the purchase consideration of the parents, we've derived it here as 496. And the examiner provided us information here that says NCI is measured. Let me copy the information. NCI is measured based on the group policy at fair value. Okay. Let me keep that information somewhere here. Let me keep it next to this goodwill. Let me keep that information here. Therefore, 100 billion. Therefore, what's the total consideration? total purchase consideration. Now, what is the fair value of the acquired net assets of Omni PLC? Okay. We'll start with the ordinary share capital and the pre-acquisition retained earnings. Now, let's go back to the question. The share capital was 200. Okay. The share capital was 200, and I think we have it somewhere here. Yeah. And the pre-acquisition retained earnings, which we have determined before now, we have it here as 120. Therefore, we have some adjustments, including fair value adjustments on property. And what was the adjustment? If you remember, that's 50 billion. We said we should increase our retained earnings. Okay, is there any other adjustment again that affect pre-acquisition? I don't think so. I don't think so. Any other adjustments? Okay, I don't think there's any other adjustment. I'm scanning through my question. I don't think so. Okay, therefore, everything else sum up to 170. Therefore, I sum this up. Okay, what's my full goodwill? That is this. Now, remember, we are told that the goodwill has been impaired. Impairment on full goodwill. Recall, we said here it has been impaired by 30, which then means that by that 30, what's now our consolidated goodwill, which is a goodwill as at reporting dates. It's 196. Okay, that is that. Any other question here? Which means our full goodwill is 226, but after impairment, it becomes 196. Sorry, I think the network tripped off. Okay, can somebody volunteer to read this? I want you to read something here with respect to that information on the treatment of intangible asset as a result of government banning or legislating against views on banditry. Okay, Kevin Zaire, hold on, let me grant you access. Over to you.
Okay. The technical note. The information provided is considered perceived to bolster the rationale for the impairment loss on the goodwill required to be accounted for. In this suggested solution, no further treatment concerning the following is or are not considered. 1, no provision is recognized concerning the possible compensation that the subsidiary may have to pay. There is no sufficient information concerning the assessment of how probable it is for provision to be recognized in line with IS 37. 2, there is no consideration for the impairment of the intangible assets. The television program license or rights because there is insufficient information for recognizing the same. Also, there may have been a possibility that the subsidiary itself may have effected such. Minimal information shows no adjustment may be required.
And I'm saying this from a technical perspective, okay? But from an examination perspective, I treated this as if those information are sufficient enough to assess all of those things. But what matters much more is that you have the understanding of it as the case may be. And wherever information is not explicit or is unambiguous, you have the opportunity to make some assumptions and expression. But again, assumptions you make are assumptions that are reliable, that are reasonable, you understand, that are logical, not necessarily making assumption for just an assumption's sake. Okay, that is that. Thank you. Now let's look at additional information that we have not treated. We've treated 1, we've treated 2, we've treated 3, and we are now in 4. Therefore, let's look at this 4th one. The 4th one says that Mommy PLC sold goods worth 20 billion naira to Daddy PLC during the post-acquisition period. 5 billion of these goods were included in inventory of Daddy PLC as at the reporting date. Mommy PLC made 8 billion on the total sales. Therefore, who can interpret this information for me? Who can interpret this information there? Who can interpret? Okay, Carol this Sunday. And grant you access. Over to you, Carol.
Thank you, sir. It means that as at acquisition, 5 billion of this.
There's too much noise on your background. Can you leave that arena? Okay, Toby, over to you.
Thanks, sir. The transaction is an upstream transaction, that is from the subsidiary to the parent. And we are told that there are some item of inventory in the store or as part of closing inventory for the subsidiary, which is the buyer. Now, the subsidiary, the parent, sorry, which is the buyer, the subsidiary must have recorded a profit, while the parent has carried it as cost. So you need to eliminate the cost, and so that they will be balanced, you need to eliminate the cost and the profit that this one has recorded. In so doing, there is what we call unrealized profit. And that will affect both the parents, which are the beneficiary of the subsidiary, the parent, and the NCI, the unrealized profit. Am I in line?
Thank you. No, yeah, you're in line. Now, you first of all introduce what is germane critical here. Now, what is germane is that you've characterized this transaction as an upstream, which means it was the subsidiary making sales to the parents. Therefore, any profit made in this transaction is made by the subsidiary. Now, the first thing is that I want to know what is the margin. And why am I using the word margin is because you have given me the sales value, which was 20 billion for the whole year. And you have given me the entire profit made by the seller, which is money of 8 billion. Therefore, what is the margin? Remember, margin is what? Ratio of profit to sales value. Okay? If that is the case, let me bring out the information out here first. Total sales is 20 billion. Total profit on sales is 8 billion. Okay, now unsold goods, which is the inventory in the hands of the buyer. Who's the buyer now? Daddy. Is
5 billion.
5 billion.
40% of 5 billion. Realized profits.
Therefore, what then do we need to do? In this case, is that the margin here is what? Profits as a ratio of sales. And that is approximately 40%. Now, the question then is, unrealized profits is only in relation to unsold goods. Therefore, the amount of unrealized profits on inventory, which are unsold goods, is the margin, in this case, multiplied by the value of unsold goods. And what is that?
2 billion.
It is 40% of 5 billion, which is 2 billion. Therefore, in that case, the unrealized profits is 2 billion. Any question on this? Okay. Now, how do we account for it? Accounting entry. Because the profit was made by the subsidiary, it then means that the group profits from the angle of the subsidiary will be affected. Okay, and we need to reverse it by charging it out of the subsidiary's book, which means we debit it. And we credit the group inventory. Now, what is the group inventory? The group inventory from the angle of the parent is overstated by 2 billion. Okay, and the subsidiary's profit is overstated by 2 billion also, of which ultimately 80% of it is borne effectively by the parent, and 20% is borne by the non-controlling interest. And that is that. Any question on this? Okay. Now, we can go back to the last information. And what's the last information? Mommy PLC has a trade receivable balance of 9 billion. And this trade receivable balance did not agree with that of trade payable by Daddy PLC. Okay, and this is as a result of cash in what? Transit. Now let me show you what has happened. What has happened in this case is very simple. It's like, let me show you a reconciliation statement. between mommy's receivable and daddy's payable. Okay, mommy's receivable and this payable. Now, what is the balance in the accounts? We are told that intercompany balance as per account. Now we are told that in the books of, where's the information here? Yeah, we are told that in the books of in the books of mommy, I think even in the information I can provide, this is wrong. Mommy should have trade receivable because mommy is the seller. Okay. This should be mommy's trade receivable. Whereas this is daddy's trade payable. Remember, it was mommy selling. Okay, that is that. But regardless of it, it still doesn't change anything. Okay, now here you have 9 billion. Here you have 14 billion. Sorry, receivable of 9. Okay, and here you have, sorry, 9 minus 5, here you have 4 billion. Now what we are seeing here is that mommy claims he has receivable of 9. Daddy says he has payable of what? 4. How do you get payable of 4? Is because from this derivation, from 9 minus 5. And what is that 5? Cash in transit. Therefore, we are now told that there's a cash in transit that brought about that difference. And if you have cash in transit as a difference, what do you need to do? You need to recognize that this cash exists, only that it was not contained in either books. Okay, somebody said something. Trade payable here has nothing to do with the upstream transaction. Why do you say so? What brings about intercompany trade payable and receivable? Hello, Infinix, let me give you access to express yourself so that I can explain also to you. Over to you. Can you unmute? Can you unmute, please? You said, okay, you see. You now got it right, have you? Because they are not just talking about trade payable or receivable, they are talking about intercompany. And it arose from transactions. Okay. Toby want to say something? Over to you.
Yes, sir, I didn't get this number additional information 5 very well. Why do you have to change the conversion receivables to payable and payable to receivable? Was that because of because of the additional information 4?
Yes.
Is that okay? Okay.
The only transaction between two of them in that year since acquisition is because subsidiary sold to the parent. And how can the seller still be having payable to the buyer?
Okay. Okay.
What it was because they transposed the question and they didn't take note of changing that order. Okay. You sold something to somebody and you are still the person owing that person. Is it possible? And that's the only transaction that occurred between two of you. And the same thing the guy in Infinix phone was trying to say, but he later saw what I was talking about. But again, whether you treat it as such, still doesn't change the result because you are still going to cancel that intercompany balance. But I'm just trying to make you have understanding of what it is, so that tomorrow you will not be wondering that how come a seller is now indebted to the buyer, when that is the only transaction that occurred.
Okay, thank you, sir.
Now, accounting entry for cash in transit. Now, for cash in transit, remember, cash in transit are cash owned by the company within the group, of which upon transfer is neither in the books of the sender nor in the books of the receiver, but it is hanging somewhere. An example I always use is, you see a situation where you transfer from your bank account and it didn't get to the person you transferred to, and it's already left your bank account. Therefore, it's hanging somewhere. And unfortunately, it's hanged as at the reporting date. Even though a day or two later, you're able to receive the money, but what happened to your reporting as at the date of consolidation? And that's what we are trying to adjust for. Therefore, cash in transit is still a component of group cash and cash equivalents. Therefore, we debit that with the 5 billion. And we credit. Now, as I've always told my students, regardless of who you credit or debit, depends on the perspective, and it still doesn't change the situation, which we are going to see. I can decide to say that cash was reversed. And if it's reversed back to the books of the sender, which means it will back to daddy in this case. That is payable account. And what then happened to daddy's payable account is that I credit it with 5 billion. Okay, in that case, what happened? I come here and say cash in transit. And when you credit a liability account, what are you doing? That's simply increasing that liability, which means if I come here and credit is 5, what simply means is that my balance will now be 99. At that point, they now agree. Therefore, I can call this agreed intercompany balance. And if I do otherwise, and I say no, the money was eventually now received by the subsidiary, who is the seller. Therefore, I credit the subsidiary's trade receivable. In that case, when you credit a receivable account, which is an asset account, you are reducing it. And at the end of the day, whether it is 9944, we eliminate intercompany balance. And that's why I said, don't ever worry yourself about the position, because it's still going to cancel out. And how do I do that? Account that is in debit, which is that of the parent and subsidiary, will be credited to eliminate. Account that is in credit, which is that of the parent, will be debited to eliminate. Therefore, that is trade payable account and credits, monies, trade receivables account. With what? With whatever it is here. And that is it. And upon elimination, everything cancels out. And that's why I said, depending on what you do here, you still get the same position as the case may be. Okay. Any other question? Now, that should have been the final. That should have been the final workings or adjustments. But I'll shock you that that is not the final adjustment. Who can tell me why and what is the final adjustment? Who can tell me why it's not the final adjustment? And you tell me what the final adjustment is. Over to you.
You still have the adjustment for consolidated retained earnings and NCI.
No, I am not looking at those ones. I'm looking at adjustments before I determine the effect of all adjustment on NCI and consolidated retained earnings. What's it?
Okay.
There's one adjustment. If you go back to the question when we started, let's go back to the question. I'll give you a clue of it. The clue is here. It's between here and here. If you can marry the two statements together. Okay, Opadosu, over to you.
Yeah, yes, sir. I think the adjustment that needed now is the 12% loan notes.
The interest on that 12% loan note, because we are now at the end of the year. Remember, I mentioned it earlier. That is it. Thank you very much. Therefore,
Yes, sir.
we'll come back here and say, accrued interest on what? Loan notes. Now, the loan amount is how much? Remember, the loan amount was 160. Okay, and we said in the information, we need to assess whether in one way or the other, the examiner has told us that the loan note has been, the interest on it has been accrued on or not. Now, and all through, I don't think there's any place, I'm trying to check from the question, where it has been accounted for. I'm trying to stand through, and I'm also looking at the balance sheets. It was not stated, but we have two assumptions here. Now, if you assume on the basis that the interest that you accrued for, or the interest has been paid for, therefore there won't be any adjustments. But in this case, let me state it clearly that assumption on 12% loan notes. Now, there are two scenarios which I'll state here. Scenario one. Where it is assumed that the interest on the loan notes has been accounted for and more or less paid. Hence, no adjustments is required. Scenario two. Where it is assumed that the interest on loan has not been accounted for or more or less paid, hence the underlisted adjustment is required. And that's what I wanted to do now. And what is the underlisted adjustment? First, loan note is this: interest per annum is 12%. Okay. Duration being accounted for is just 1 year. 1 year. Therefore, accrued interest will be 12% of this times 1 year, and that's in billions. That in billions. Okay. Now, what is the accounting entry? It's debit, the group profits, which in this case is a consolidated retained earnings. NCI has no business in this because it's a loan of the parent. Okay. And credits our other payables. Or let me put, I think we have accrual. In the balance sheet, we have something like accrual there. Let me go back to the balance sheet. We have other accrued expenses, therefore I'll put it as other accrued expenses. Therefore, okay, that is that. Now, these are all of the adjustments. Now, the only thing that is left for us is to determine our consolidated retained earnings. Let me put it as the last year. Consolidated retained earnings and non-controlling interest as at 31st December 2020. All figures in billions. Now let's start with what we have as our retained earnings for the parent, that's PLC. And if you remember, we'll determine it up here as 320. And we'll determine non-controlling interest value at acquisition dates. I think we are told that was 100 billion, remember? We make use of it here. Now the first thing here is post-acquisition profits. Of money. And we have to share that in ratio 80-20. And what is the 80%? This is the 80% of the post. Remember, we split it here. This is a post 50. And also 20% for NCI. Of the 50. And that is that. Now, other adjustments. What are the other adjustments? One, we'll follow step by step so that we don't miss anything. Additional depreciation, you can see it here. I'll link this. We have 16 and 4, which we are told to deduct. Other adjustments, let me just pick it. The first one is additional depreciation. And there, we said we should deduct by way of debit. $16 from parents and 4 NCI. Okay, second adjustment. If you follow step by step, that's why you have to do your work chronologically. Is intangible assets fully impaired? You also said we should take away, deduct how much? 32, the parents. And 8, the NCI. The third adjustment is our reimbursable. We said we should credit the parent 10 and NCI 2. Okay. Okay, which other adjustments? You won't miss anything when you follow it in those orders. Impairment of goodwill. We said we should charge 24 to the parents and 6 to the NCI. Which other one? Unrealized profits. So we should charge 1.6 to the parents. So I will put the name first. And charge 0.4 to the NCI. Okay. What other adjustments? Okay, these are balance sheet adjustment. It has no, okay, the last adjustment is accrued interest on loan. And that is to the parent. All things being equal, okay. Now, what do we do? At this point is for us to prepare a consolidated balance sheet. Therefore, let me just put it somewhere here. Let me copy a blank template. Let me copy this. Now, from the information we have, let me just copy this balance sheet somewhere here so that I can see what I'll be doing. Okay, I believe you can see what I'm doing. Now I have information about this, okay. I can put as many information there. Inventory, trade and bank, I have it there. Share capital, there was share premium. Therefore, let me just bring that in. Share premium. Okay. This is not Pali. This Daddy group. This Daddy. Okay. This Daddy. Now, which other information? Non-controlling interest, we have that here. Non-current liabilities. Now that I have 12%. Liability, I have trade payable. I have other accrued expenses. I have current taxation. And I have bank overdraft. Okay. This is sorry. Now let's start our consolidation. I'll put the figure here first before the adjustment, 650 and 350. Investments. $160 and 0. Goodwill and others. The other, which we have before now, was 0 and 40. Inventory, I have 100 and 25. Trade receivable, I have 190 and 70. Bank, I have 0 and 35. Share capital, we said only that of the parent, that is 350. Retained earnings, share premium does not exist before. Share premium before was 0 and 0. What happened after? We'll see it. Retained earnings, we said we'll pick it from consolidated. I can just go down here. I just put that one here. NCI 2, I'll take it down here. Okay, loan notes, what I have is 160.40. Trade payable, I have 150.60. Other accrued expenses, 40.20. Current tax payable, 50.30. Overdraft, 30.0. Therefore, we've added that information now. The question then is, let's pick it one by one. Our property, plant and equipment is 650 plus 350. Now, there were two adjustments. If you remember, the first adjustment was the fair value upwards, which increases our PPE by 50 billion. I click that. And second adjustment is additional depreciation that affected that PPE subsequently, which is 20. And once I do that, it gives me this amount. Okay, therefore I'll come here, I'll say, what are the two adjustments I have? Add 50 and subtract 20. I'll put them in red. Take notes, and they flow from that place, you can trace it. Investments. This investment is cancelled out. Remember, the investment was cancelled out. Let me even trace it there for you. It was cancelled out from our computation of goodwill. Yeah, 496. Remember, that 496 was part of this 160, which eventually was cancelled out. Therefore, take note of it. Therefore, what will I do? I'll say minus 160. Which means that what I have here is 160 plus 0 minus this 160 that was part of the acquisition, cancelled out. Therefore, this should not show in your balance sheet. That's why it's 0. Goodwill. The goodwill came from our computation here after impairment. The intangible asset was originally 0 at 40, but there was an impairment of the entire intangible assets, which we talked about here, of 40. And that went to 0. And that's why I can put this 40 here, minus 40, for you to know where it's coming from. Okay, this 60 is also an adjustment. Anything you see in red is an adjustment which you can trail. Okay, this is flowing from our computation. Now, inventory. $100 plus 25 minus the unrealized profits. Remember, there was unrealized profit here to the tune of 2 billion. And that is what brought about that. And therefore, I come here and it was 2 billion. trade receivable, 190 plus 70. Now there are some adjustments here. The first one was issue of cash in transit, which is said we should remove from subsidiaries trade receivable, which means I'll say minus 5. Okay. And again, we are told to eliminate. We eliminate 4. At the end of the day, what do we have? 12 more. Therefore, this is minus 5 for cash in transit and minus 4 for intercompany cancellation. That's how we arrived at that. Bank, we have 0 plus 35 plus, remember there was an adjustment for cash in transit, which is say we should increase our cash position, and that is it plus 5. And therefore, this is plus 5. Okay, in that case, we can sum up this. But there's one other adjustment that I can put here as other receivables. Who can remember that our reimbursable costs from governments, other receivables. Other receivable does not exist before. It was 0 plus 0. But now plus, there's 12 billion that will be compensated for, which immediately become receivable, based on the fact that we have written off our intangible asset, and this is the 12 billion here. Therefore, I'll put there 12. And which means 0 plus 0 plus that 12. Okay. Our total asset, all things being equal, will be current and non-current. And what is our non-current? I sum it together. Okay. Next, share premium. There was a premium that we need to recognize, remember, upon issue of shares. And that was this amount. Where's our account 20 years? Can you see it? 160 billion. Okay. And also parents, 80 billion. Therefore, we'll come here. We say we have 160 billion. And we have the parents. Initially, the parent was 350. Subsidiary was 200. We eliminated the subsidiary 200 and we added another 80 to the parents because of the acquisition. Therefore, what is the total value there? That will be automatically 350 plus 200. Later, the 200 was eliminated and we add 80 in additional shares, that's 430. This we have is 0 plus 0 plus 160. Where's that 160? That's it, yeah? this other 80, let me link it. The 200, if you remember, was the 200 share capital, yeah? And the 80 was this, which is simply just for you to be able to trail it. Okay. Now, loan notes 160 and 40. Trade payable 150 plus 60. Remember, there was intercompany elimination, which was the 4 billion, yeah? Minus 4. Accrued expense 40, 20, plus the interest that we talked about here on loan, based on the second assumptions we considered. That is interest, accrued interest, 190, 19.2. 19.2. Current tax payable, 50 plus 30, that's 80. Bank overdraft, 30 plus 0. Plus, don't forget, there's an element of overdraft in our acquisition, this cash consideration. If you remember, we had it here in our entry, bank overdrafts. That's 96. All children equal. Now check. Let me sum this. Let me sum this. And that is our position, which agrees. Okay, but one thing is that it has agreed. Another thing is that some of the assumptions we made, if I twisted those assumptions, what will have been the position? Okay. Now you see what I'll do now. I'll start to make different assumptions, twist those assumptions we made. This is the initial solution. I can make one or two other changes to my assumption. Amended solution based on changes in the assumption. Now, what assumption do I want to make? I'll start from the last assumption we made. And what was the assumption? Is that interest, this was the assumption we made earlier, but I want to go with this assumption now. And what is the assumption here? The assumption here, is that the interest has been accrued for, which means the interest might have been component of this information here, might have been part of these other accrued expenses, which is their interest. If that is the case, see, my balance sheet will change and it's going to agree because I've modeled the solution. And what we change there is that I won't recognize this again. Therefore, there's nothing to recognize here, which means I can delete this because it's not required to be computed. And once I delete it, I take it out of my adjustments. And if that is the case, what is my new position? My new balance sheet position is this. Sorry. I'm coming. It's no longer there. And also I adjusted for it in, okay, that is it. It's still going to show me this position, which means I've taken everything up. But you will find out that the solution are slightly different. Let me put it side by side so that you see what I'm talking about. Let me go and copy the other solution. And cut it and paste it by the side. Look at it by the side by side. Now, see where the changes lie. This is exactly the same, but see the difference here. Earnings consolidated is 276.8. This one is 296.0. NCI here is 94. Here is 94. Now, accrued expenses here is 79.2. Here is 60, which means the difference is just between the treatment of how that interest reduces the consolidated earnings and also reduces the liability, all because it has been accounted for before. But if it has not been accounted for before, it means our liability have to increase and our retained earnings have to reduce because of the additional expense being recognized. That is that. Okay, now let's take that one out. Let me also now go to one other assumption that we made. I'll call this revised solution. Now, there's an assumption we also made with respect to with respect to this this intangible. Okay, if you go by what I read earlier, assuming this is not required, these treatments are not required. Sorry, it didn't show well. Let me just say not required. That's enough. If this is not required, which that means that I'm going to take all of this off and only treat it with respect to impairment based on what I read earlier to you guys. Okay. Therefore, what will happen in that light to our solution. Is that the treatment we accorded them, we'll take them off. What are the treatments here? These two treatments, I take them off. And once I take them off, I'll take them off from my balance sheet also, because I have them here, intangible assets, and also have one under receivable here, this 12. Okay, sorry, it seems I was muted. Okay, sorry. Okay, sorry. What I was trying to say is this. We are trying to look at a new solution. Now, the new solution is that in this case, this is the new position we have. And what is the position with respect to cash in transit? Where is it? Okay, is that we are using it exactly the way Ican has put it. And what is it? Mommy PLC has trade payable of 9 billion. Why Daddy has trade receivable of what is more than that? And the reason why it's more than that is because Mommy would have paid 5, which Daddy did not receive as at the reporting date. And on that premise, we claim that Mommy is now payable. Daddy is now receivable. And Mommy receivable payable is 9, according to the information. And Daddy payable will be 14. Why? Because if Mommy that has paid cash, which we now found that is in transit, has claimed that that cash has not been received by, Daddy has claimed that he has not received it. It then means that Daddy's receivable position will be higher than Mommy's payable position by that amount of cash in transit. And that is why Daddy's position is higher by 5 to make it 14, which means this position is what brought about that disagreement. Now, to agree that position is that we now trace that 5 difference is cash in transit. That cash in transit has now been adjusted for as thus that the money reverts eventually to the subsidiary's account. Therefore, if we treat it as such, the subsidiary cash balance will increase. The subsidiary payable will also increase, and that is the entry we have passed here. Now, since we have passed that entry and effected it here, our new balance is now 1414, which we need to eliminate. Which then means that from this adjustment we have to make here, it then means that the receivable adjustment is 1. To only eliminate from the angle of the parent, how much are you eliminating from the angle of parent? 14, which I'll put here, 14. This is receivable. And this is payable. Therefore, what do? We come to the receivable point, we deduct that 14, which is the parent. And how do I do that here? Let's say minus this 14, so that I can trace it. $14. Okay. Now, that gives me that position there. The other one is the payable leg. The payable leg first is that I added 5 and I deducted 14. How? You see it here. The first 5 I added was the Mommy's payable that later recognizes return of the cash back to his account since he failed. And that is 5 to increase it to 14. And we eliminated 14, which is what you see here. Eliminated 14, which is what you see here. Okay, now what do? We come back there. And that is what? That is what I have here. First, I eliminated the 5. And I also eliminated the 14. So that's, sorry, add the 5 because it's a credit, and I eliminated and also add the, this is eliminated the 14, yeah, which is debit. And on that basis, we have our position. And if you check the Ican solution, this is what it exactly gives to you. But again, it's not about the solution, it's about you understanding, because there is a blunder here that you can't say the seller is having payable again to the buyer for the same transaction. It's supposed to be reverse the case. But again, the beauty of it is that if you correct for it in the exam and you are sure the examiner will mark it, if you treat it the way they give it to you, they will equally mark it. And that is the position there. But again, you understand the logic behind it, that you cannot, as a seller, be owing the buyer for the same transaction in which you have sold and the buyer has yet to fully pay. Okay, any other question before we go on 30 minutes break, and we converge probably by, okay, I think we might not go on break. We'll just end all of the session by 2, and we'll communicate the next time we'll be having similar session. But in that case, we'll be looking at other areas we also have looked at today. Okay, any other question, contribution? And I'm going to send this thing first on this chat and also on various platforms to which this program was, the revision class was communicated. Any other question? Contribution, you can send a chat, or you can more or less request from me. Someone said, can we get solution charts? Yes, I've said that before now, that I'm sending that to you immediately. Okay. What else? Any question? Any addition, contribution? Or do you have any other general question? Or the topic you want us to consider next, in addition to what we said we'll look into later? Okay, Kaide, over to you.
Sir, thank you, sir. Please, I'm looking if you can brush through cash flow statement as well, sir.
Hello?
Do you get that, sir? Yes, sir. I said if you can brush through cash flow statements.
Yeah, what do you say? I can't hear you.
I said is like a suggestion if you can brush through cash flow statements, cash flow.
No problem. I can do that.
All right, sir.
Also,
thank you, sir.
I can start. Yes, I'll do that now. Just give me 1 minute. Hello. Yeah, sorry for the network. I don't know what's happening to the two networks, but again, if you want me to answer specific question on the cash flow, I will do that now, okay? But for us to solve a problem on this comprehensive question, we need to agree a time so that we'll share the question in which we want to use. But again, you guys can proceed to downloading I'm sending it now. You can download it now, okay? Please kindly download the solution now to the question. Okay, I've sent it. You can see it, download it, and I'm also sending it to your various platforms. Now, what specific question do you want on cash flow now? And so that I can just, or if you want me to just give you a background to it, I'll do that. Okay, I think what's going to happen is that the next class, we might look at statement of cash flows in addition to, it will be like a key discussion, and possibly we'll look at other aspects of it. Okay, in the absence of no specific question, someone said, kindly let treat May 2020 questions, sir. Okay, we'll look at it. I might use that as, okay, for cash flow, I might use that as it is, but again, you can see the solution in what I've sent to you earlier, which was a solution, but we'll look at it together. That might be the question we'll look at. There's no problem. Okay, thank you very much. Ensure you download this suggested solution in the Excel format, and you glance through them and you play with those solutions. Okay, in the absence of nothing else, thank you very much. And I think God bless you all. Bye.